Welcome back. We've got 13 minutes left in the trading day. We're now in the closing bell market zone. Commercial-free coverage of all the action going into the close. Today, joining us, we have Veritas Financial founder Greg Branch with us. Let's get, first of all, to the main markets. The Dow sharply underperforming today. Citigroup came out with a note calling for a 10% correction before year-end. The firm pointed to too many inexperienced investors plowing into technology, an action that Citi says is reminiscent of the 99-2000 era. Citi cut its outlook for the U.S. stock market to neutral off the back of that. Greg, I'll come to you on this. I guess you haven't been surprised because you've been fairly upbeat on markets to see us at these record highs. Do notes like this or the Delta variant or anything else make you think now is the time to start to take a bit of profit?
Well, it certainly gives me pause, right? Recall that my thesis was that consensus was well below the true earnings power of the companies, given the recovery we expected, and that would play out with an earnings revision cycle and the beats that we're seeing, right? In this quarter, the third quarter, 85% of companies that have reported have beat their earnings. But as we look through the remainder of the year, what impact is the Delta variant going to have on that? And it'll be twofold. Domestically, as we expected the unemployment rate to dip down below the 5.7% that we saw beforehand, will the Delta variant cause further deterioration of that already limited pool of available workers? And so that's going to keep wage pressure continuous throughout the back half of the year, I think. And then on the global side, our trading partners, our sourcing partners, they are much less progressed on the vaccination curve than we are. So Mexico's at 20%, Taiwan's at 1.8%, Thailand's at 5.9%, and so on and so forth. And many of these economies are closing back down. That will keep our supply chains fractured. We'll continue to see component and raw material shortages in a much more acute way than we anticipated and for a longer duration than we anticipated. That, too, will strain productivity and keep those inflationary pressures in place. And so whereas before I looked across the board and thought consensus was light for everything, now I'm starting to look at some sectors and wonder if consensus isn't too high.
How do you read the economic data we're getting in that context? ADP was a miss, raising maybe some concerns about the big jobs report on Friday, and yet services are expanding at a record pace.
You know, it really depends on how the Fed is going to use that data, right? We had 9 million openings the last 2 months, record openings, which is indicative of the fact that we actually don't have a supply of jobs problem. We have a job consumption problem. And so whether it's today's number or whether it's Friday's number, you know, the narrative can be construed that what we're doing is working if we have above consensus numbers. If we have below consensus numbers, we need more of the same. So, you know, Jackson Hole is going to be imperative because those numbers really matter in terms of how it changes or continues the Fed's posturing.
Newly public company Robinhood getting the meme stock treatment of late, particularly today. Trading was halted for volatility several times, and Robinhood's currently up about 30-40%. We'll get that price up for you in a moment. Best daily performance in its 5 days, 47% no less, in its 5 days as a public company. The trading app had an initial lackluster debut on the markets, closing down 8% on its first day of trading just last week, but of course has performed very strongly since then. Chip stock AMD also getting caught up in the frenzy. AMD's dollar volume today exceeding $20 billion, nearly the equivalent of the combined volumes of Tesla, Apple, Microsoft, and Amazon today. Meantime, some of the original meme stocks like AMC, Bed Bath & Beyond, COS, and GameStop are selling off today, but some pretty extraordinary moves there. Greg, does this type of thing make you worried that Citi note has some truth in it, that there's a little bit too much retail investor engagement and that we're building a bit of a bubble in some areas?
Look, over the last year, we've saw retail and investor activity be fairly significant in whatever theme we were talking about, whether it was the reopen trade, the ESG trade, the electric vehicle trade. So that's not particularly surprising. And quite frankly, at this juncture, I'm not sure that it's wrong. At the end of the day, some of our more cyclical sectors, some of our more value-oriented sectors are facing tremendous pressure whether it's food costs, whether it's rising labor costs, particularly at the mid to low end. While on the tech side, we've seen with the earnings we've seen thus far that they have decimated some of the narrative that had people hesitant. We were concerned that their results were a result of COVID pull-through or COVID bump, and they have put that narrative to rest. We've seen strong growth in cloud. We've seen strong growth in digital advertising. We've seen margin expansion at Google, at Microsoft, and at AMD, and pretty much across the board. And so I think that the market is now bearing witness that we are seeing secular tailwinds across many of the tech sectors, and I think that that's something we should capitalize on while we see inflationary pressures weigh on some of the other sectors. So I think that breadth will narrow again.
7.5 minutes left of trading. Wells Fargo Investment Institute strategist Scott Wren also joins us now in the market zone. Welcome, making a cameo. We're talking Robinhood, Scott. Is that indicative? It's up, what, 40% or so as investors pile into options here. Indicative of something in the broader market, the retail fever, or just you look at it as stock specific?
I don't really think it is the retail fever, Sarah. I think what's happened is this is just the latest in a series of stocks that trading retail investors, not retail investors, there's a big difference there, have become interested in because of the volatility. Initially, they're pretty interested because it just keeps going up. It's generally another story when it drops like a rock on a couple of days, as plenty of these other stocks, maybe similar to Robinhood in terms of trading patterns have been. So for us, this is not a pattern that tells us, hey, there's something wrong with this market. We don't think there is. I think Brad mentioned that there's been a stumbling here in terms of breadth. Some of these more value plays have stumbled over the last 3 months or so. But for us, it's exactly that. It's a bump in the road. We're still leaning towards a continuation of this expansion. We're neutral technology. We had been overweight for a long time. So you need some growth. But if you look at the earnings, second quarter is a perfect example. Where's the triple-digit earnings come from? It's the sectors that are very sensitive to the ebb and flow of the economy, and we don't think that's going to change anytime soon.
10-year yield at 116, oil prices down more than 3%. Target Chairman and CEO Brian Cornell joined us earlier this hour. Here's what he said about the state of the U.S. consumer.
I think it's a very healthy consumer environment. Obviously, stimulus has helped. But I also think there's just pent-up demand to get out and spend. We had a very strong year in 2020. Our top line grew by over $15 billion. We added $9 billion of market share. We saw a very strong start to the year with our comps over 20%, driven by stores. Our store comps grew by 18% in the first quarter. And I think it's just a sign of an American consumer and a target guest that wants to get out, and they're getting out to stores, and they're shopping all of our categories. So I think it's a very strong consumer environment right now.
We're hearing this message, Scott, from a number of retailers on the show, during earnings, and getting some pretty strong outlooks as well. Target reports in a few weeks, so we couldn't say much on that front. But are these consumer discretionary stocks, retail stocks, still a buy? They've already had a good run on this idea that the consumer is doing quite well.
Well, for us, Sarah, as a sector, we're neutral. But for the industry groups within consumer discretionary that are reliant upon consumer spending, we think this labor market's going to vastly improve from where it is now, despite this ADP number this morning. So we like anything that's tied to the consumer spending, better jobs, more money in your pocket, those sort of things. Now, we backed off and went neutral on the consumer discretionary sector a few months ago as well. We had been overweight that for a long time because you have to remember that there's probably 5 or 7 stocks that are really kind of growth stocks and almost technology stocks to some extent that really run that particular sector. And those 5 or 7 stocks, their valuations were very high. We felt like we wanted to back off there. But the underlying industry groups, which make up a much smaller percentage of the market cap in that sector, still look pretty good as far as the consumer spending benefits to those groups go.
3.5 minutes left in the session. We're down about 0.4% on the S&P. Uber will headline another huge hour of earnings after the close today, and Deirdre Bosa has a preview of that name for us. Hi, Dee.
Hey, Wilf, well, after Lyft reached adjusted EBITDA profitability ahead of schedule, the stakes are now high for Uber to hit or get closer to that milestone. Investors, though, they may be likely more focused on the driver shortage and how much that is costing Uber. Uber, of course, has food delivery as well, so investors will be curious if demand has held up amid the reopening. Also eager to hear any color on the current quarter so far, given the rise of the Delta variant on both the delivery and mobility side. Uber shares, they're down 18% year to date. And we should note, trading about $3 below its 2019 IPO price. Back to you.
Dee, thanks so much for that interesting move there today in Uber based on those Lyft numbers as well last night. We'll see how Uber does in a short little while. Greg, what's your take on these sorts of names and whether they're going to benefit a lot from reopening?
Right. Well, with regard to Uber, I think Dee hit it right on the head. We will be looking at driver supply. Not only have they been able to open up more supply hours, they opened up 25% in May, and have they been able to continue that trend, but what did they have to spend to do it? Because the question becomes, how much of that do you pass on to the consumer before Uber becomes a non-compelling value proposition? And so that'll be the key, on the one hand, looking at driver supply and what it means for pricing and margins. But on the other, will they actually achieve adjusted EBITDA break even this quarter, as some suspected? I suspect it will be pushed out until next quarter, but those will be the two key issues. Going back to retail, I laser focus in on the value shopping trend that I think is going to emerge as these inflationary pressures continue to make their way through our economy. With real wages not really rising, given the inflationary pressures we're seeing, I think, agreed, you'll see an anxious consumer willing to go out and spend, but on the other hand, looking for value. And in particular, I think those companies that have used this time to invest in their e-retail infrastructure, that have invested in off-site fulfillment, that have invested in shorter delivery duration, they're going to have a structural advantage. This favors the Targets and Walmarts of the world versus the Rosses and TJ Maxx. And I think we saw that with Target last time, where they reported 23% year-over-year same-store comp growth, where they reported 50% growth in digital on top of 140% that we saw last year. So I do like consumer, but I'm more targeted on things that offer a value proposition.
As we head into the close, we've got just about 35 seconds left to go. Let's check on where we are in the market. The Dow is pulling back today. It's being weighed down by a few movers. Amgen off earnings, Caterpillar, 3M, Honeywell. The industrial stocks are selling off today. Salesforce, Nike, and United Health are the only winners in the Dow right now. S&P 500 is also under pressure, about 0.5% or so. Technology and communication services are strong, but utilities, consumer staples, and energy, those are the three worst performing. Actually, a number of worst performing. Industrials are also down a lot. Financials are also down about 0.75%. NASDAQ closes positive, just over 0.1%. Bucking the trend on some strength in tech, and Moderna having another very strong day.
NASDAQ positive, but Dow pretty much at the session lows, down 323, 0.9%. Welcome to the closing bell, everyone. I'm Wilfred Frost, along with Sarah Eisen. As just mentioned, the Dow closing pretty much at the lows of the session, down 0.9%. S&P nearly 0.5% lower, while the NASDAQ eked out a slight gain. Two sectors were positive on the S&P: communication services and tech, while energy led the declines, down 2.9%. Crude oil down 4% today, is down 8% so far this week. We have an action-packed show for you, as always, coming up here on the closing bell. Uber, Electronic Arts, Etsy, MGM, Booking Holdings, and Roku all ready to report their earnings. We'll break them down, of course, as soon as they cross. Plus, Roku's CEO will join us, Anthony Wood, to discuss those company results even before the analyst conference call. First of all, though, let's discuss the markets in a bit more detail. Scott Wren, of course, still with us, as is Greg Branch from Veritas, and joining us now, Gabriela Santos from JP Morgan Asset Management. Gabriela, I'll come to you first of all, and what you feel about that data that we got this morning, very strong on the services side, a little bit soft on the payroll side, and how earnings season is going as a whole, and whether it justifies the market levels we're seeing.
So I think we still have a lot of questions here in August going into the fall. And frankly, today didn't provide any definitive definitive answer. So we're still wondering if we can sustain this significant above trend growth pace for a few more quarters. That's going to depend on whether we resolve some bottleneck issues, as well as if the private sector can pick up the baton from the public sector. The ADP and ISM didn't really clarify that, still citing bottleneck issues. We also want to know if the earnings season's good this year, but can expectations keep getting revised higher for 2022? And that's going to be about the reconciliation bill and potential corporate tax increases. No clarity on that quite yet. And then lastly, the third main question is on whether the Fed can start communicating its baby steps towards normalization of policy in the fall without spooking the markets. And I don't think we got any clarity on that either from Richard Claridge's speech or from bond yields, which completely remain extremely distorted. For us, probably the questions will be answered in the affirmative, which is good for risk assets, but we're not getting the answers quite yet, which keeps the market a bit trendless and a little bit volatile here in August.
I think we should pause on that labor report that we got out of ADP today, private sector payroll, Scott, which you alluded to, but pretty big disappointment, coming in about half of what was expected in terms of the job growth. Everyone just assumes that job growth is going to pick up. We're going to have a few really good-looking months, starting with Friday's numbers. Is that potentially the wrong assumption, or is this some temporary thing where the jobs are being held back still because the unemployment benefits are still being paid out in full until September?
Well, really, Sarah, if you think about it, for most of the last 3 or maybe even 4 months, the market has been talking about big numbers, and we haven't had that, that million number yet in a month. It doesn't look like we're going to get it this time. And I think if you talk to small business owners, and I talk to a lot of small business owners, we've got half the states that are not taking that extra $300 in federal money for unemployment benefits. To small businesses in those states, applications for jobs have jumped dramatically. That's likely to happen as these other states open up in September as well. So you have to have some confidence that this Delta variant isn't going to lead to a lot of lockdowns, which would be a big time headwind for the labor market. So for us, we get past these federal benefits. We know there's a lot of jobs out there that are available. We know that there's going to be lots of people out there looking for jobs as those extra benefits go away. So for us, we've talked about this when we've been on the show before. Our expectation is for a 4.1% unemployment rate by the end of year-end 2022. So this economy is going to be driven by consumer spending. It always has been. I think that's going to be the case in this recovery, at least out through the end of next year.
We're starting to get some earnings. Electronic Arts, EA, just out. Josh Lipton with those numbers. Josh.
Sarah, so EA is reporting Q1 results here, 71 cents on the bottom line. That is not comparable to estimates, but net bookings come in at $1.34 billion. That's versus a forecast of $1.28 billion from the street. For Q2, they say they're looking for bookings of $1.73 billion. That's versus an expectation of $1.51 billion. And for the year now, they say they're looking for $7.4 billion versus $7.45 billion. Andrew Wilson, the CEO here, saying in a statement, with our expanding EA Sports portfolio, more amazing experiences in Apex Legends, the groundbreaking new Battlefield 2042, that's a new shooter they say will be here in time for the holidays, and our leading live services, including mobile, we're set to deliver more great games and content to players this year. This call starts at 5 p.m. Eastern. Back to you all.
Little pop after hours, up 3%. Let's get to Uber earnings. Deirdre Bosa has those. Deirdre.
Sarah, it is a beat on the top line, revenue coming in ahead of expectations at $3.9 billion and EPS coming in at 58 cents a share. That's positive 58 cents versus an expected loss of 51 cents. But here's why. The reason it realized a profit in Q2 was thanks to paper gains from its equity investments in Didi and Aurora. Didi, of course, has had a really rough public debut, but Uber got its stake early, so recorded a gain there. And also remember that it sold its autonomous vehicle unit to Aurora for a 25% stake. Gross bookings for rides and delivery combined doubled from the year-ago period to nearly $22 billion. Uber not hitting that adjusted EBITDA metric of profitability that Lyft hit in the past quarter. The figure was a loss of more than $500 million, although CFO Nelson Chai says that it's making progress and expects that to improve to less than $100 million in Q3. This is key here forecasting gross bookings between $22 and $24 billion in the current quarter, and that may be why you are seeing shares slip in extended trade. At the low end, that would be flat from the current quarter, which was gross bookings of $22 billion. Key for investors, as I mentioned before, is how Uber is addressing that driver shortage. The company says it added 420,000 drivers in the February to July period. It is unclear what percentage of the total driver supply that is. Remember, Lyft increased by 50% quarter over quarter. More importantly, though, guys, was that enough, those 420,000 drivers? So certainly we will expect analysts to ask for more details on the call, which kicks off in a little bit. Back to you.
Deirdre, thank you. You've given us a lot to discuss. Deirdre Bosa, and don't miss a First on CNBC interview with Uber CEO Dara Khosrowshahi tomorrow morning on Squawk Box. Greg, first take on those Uber numbers. The stock is down about 4%, more than that after hours.
Right. Well, the devil will be in the details. I'm sure that we weren't expecting a guide down necessarily, particularly as we've seen some pickup at the airports. But we have to diagram what that driver ad means in terms of supply hours. That's the important metric, and what they paid to obtain that. Right. We know that they've put a lot of incentives out there to add additional drivers and tried to pass that cost on. And there comes a point where the consumer doesn't see Uber as a valuable alternative if pricing remains at its elevated levels. And so I'll have to dig in and see how they added those drivers and what the impact to the bottom line is.
The selling in Uber stock is extended a little bit, down about 6% or so now, and of course had a soft session as well. It was down about 2 or 3% in the regular session. Also worth pointing out there, I imagine, Sarah, that the gain it had in Didi might well be as of the end of June, and that share price, of course, lower than it was at that point. Whether or not that was a full sellout of their position there or not, I'm not sure. But anyway, the sell-off in Uber continuing down about 6 or 7% after hours. More discussion on Uber to come. We're joined by an analyst on that in just a moment. But firstly, let's get to Wynn earnings, which are crossing, and Contessa Brewer has those for us.
All right. Hi, Will. Right now, Wynn beats on the top and bottom lines. Revenue coming in at $990.1 million versus the estimated $932.5 million. An earnings loss per share of $1.12 adjusted. That's against the anticipated loss of $1.61. Let's talk the crucial earnings metric in the casino space here, EBITDA. It's a big beat in Las Vegas, more than $133 million, and the street was expecting less than $60 million. It was a beat in Boston, but a big miss in Macau. Travel restrictions there are increasing. Visitation is limited. I just want to put this into some perspective here. Encore Boston Harbor got better EBITDA than Wynn Macau. And guys, Boston is closed midweek. As you can see, the stock is up 1%. That beat in Las Vegas is a big deal.
Thank you very much, Contessa Brewer. A little pop for Wynn after hours. Roku results also just out. Julia Borston with those numbers. Julia.
We see Roku shares plummeting after hours, despite the fact that the company beat on the top and bottom line. It's the reach of the company that's not as growing as fast as expected. Active accounts coming in at 55.7 million. At 55.1 million rather than the 55.7 million expected. And streaming hours actually decreasing between the first and second quarter. And coming in lower than expected. So a decrease of 1 billion hours from Q1 to Q2 for a total of 17.4 billion. So that's the reason the stock is down over 7%. When you look at the top and bottom line results, they did beat estimates. Earnings of 52 cents per share versus 13 estimated, and revenues of 645 million, surpassing the 618 million estimated. Also strong third quarter revenue guidance of between 675 and 685 million versus the 646 million. That's analyst consensus. They do talk about, in terms of guidance, how varying rates of recovery from the pandemic continue to present an uncertain operating environment. So that, of course, weighing on the stock, along with the slower than expected growth of active accounts. Sarah?
Julia, I'll pick it up there. Thanks so much. Down about 6 or 7% after hours. Don't miss, by the way, our exclusive interview with Roku CEO Anthony Wood. That's in just a few minutes before he joins the analyst conference call. First, though, another earnings crossing. Bookings Holdings, Frank Holland.
Maybe that's the European pronunciation, Wilf. Shares of Bookings Holdings up about 5% right now. The company beat on revenue, but a miss on EPS. The estimate was for a $2.04 loss. The company had a much bigger loss than that, $2.55 per share. A lot to look at here. Obviously, the travel sector has been deeply impacted by COVID-19, still being impacted by the variant. But CEO Glenn Fogel, he seemed to have some commentary in here that resonated with investors. He said, we're encouraged by another quarter of meaningful sequential improvement in the booking trends, with second quarter room nights increasing 59% versus the first quarter of 2021, primarily driven by stronger results in Europe, where you are, and also here in the U.S. Again, shares of Booking Holdings up about 5% right now, despite a miss on EPS, still a beat on revenue. Back over to you.
All right, and there's more. We've got Etsy earnings just out. Courtney Reagan with those numbers. Courtney.
Hi there, Sarah. So for Etsy's quarterly results, we do have an earnings beat, 68 cents compared to consensus estimates of 63 cents. Also a beat on revenue, 529 million. The street was looking for a little over 524 million. You can see shares, though, are lower sharply by about 12%. No earnings guidance for the third quarter, but the third quarter revenue guidance range given by the company of 500 to 525 million is below what the consensus analyst estimate is. The gross merchandise sales for the Etsy marketplace did grow 14% to $2.8 billion. But the company notes that growth in new buyers did decelerate year over year. They point out it was as anticipated, and then also point to habitual buyers, the people that buy the most often, are the most loyal, continues to be the fastest growing buyer segment, up 115%. Still, though, the street wants to see those new buyers coming in and expected more from that guidance. Hopefully we'll get a little bit more on the call when that starts later. But for now, Sarah and Wilf, back over to you.
Courtney Reagan. Courtney, thank you. Well, for this was always going to be the risk with Etsy, which had done so well during the crisis. They are lapping such tough comparisons. Just some other numbers that stick out to me on this one. If you look 2 years, so compare it back to 2019, 159% growth from there in terms of the revenue. So they're clearly still growing. And outside of Shopify, it's really the fastest growing e-commerce company. If you look at the 2-year basis, they clearly benefited from the pandemic and those buyers stayed with them. The GMS, which is their gross merchandise value per active buyer, increased 22%. So still some strong numbers in here, but obviously, as Courtney alluded to, the concern is going to be around the guidance and just not seeing that growth rate or the new users come in the way that they did when people were at home. Scott, maybe I'll turn it to you. I know you don't do individual stocks, but we got so many reopening plays here with the likes of Wynn Resorts and Uber, and we got the pandemic plays like Etsy. Where are you on some of those categories and what you should be thinking about given some of these numbers?
Well, for us, I mean, I think, let's face it, that the earnings have they're up 80-some% for the S&P 500. Earnings are blowing away expectations. The market totally counted on that and expected that, and that's exactly what we've had overall. But as you look ahead, that's the thing, Sarah, is you have to say to yourself, is this economy going to continue to reopen? Are we going to continue to see the labor market better? Because if that's the case, we're going to have confident, employed consumers out there spending money. There's probably not going to be a whole lot of business capital spending that's going to try to meet surge demand. That surge demand is going to ease a little bit. But anything that is tied to the economy opening up, not just here, but abroad. And the global economy is a little bit behind the U.S., but we expect it to start to catch up toward the end of this year. That's the basic foundational belief that you need to have to lean into this recovery. And like things like energy, financials, materials, industrials, all those things are going to continue to benefit. That's what we do. So this earnings season, it's a total blowout. You could expect it to be a total blowout. This is peak growth for earnings, but that's meaningless in this environment. We're going to still see some good earnings growth and some good economic growth as we look down the road, not just the rest of this year, but next year as well.
And a little tidbit from Etsy, a 700% increase in searches for job resume templates, which tells you a lot about the economy right now. Scott Wren,
exactly.
Greg Branch, and Gabriela Santos, thank you all for joining us. Up next on the show, newly public low-cost carrier Frontier